Hey guys, Freaky Finance here. The reason why we're doing this video today is because we're going to start going into more defensive names, or that's what I'm thinking about doing, and what I have started doing. One of the reasons why is because this year's been very good. Like, we've been overweight things that have really worked, taking advantage of the April fears. And so time-weighted return rate for the past year is 52%, which is very high. Usually I don't outperform the market by that much when the market's only up 10 and 11 for the NASDAQ. NASDAQ's probably a better comp for me because I have a lot of tech companies at the time, like a lot of Google and Amazon overweight. So anyway, this outperformance usually, and this is what happened, and this is what I tried to explain with the bond video we did in April, is when I was trying to say bonds are like a lever to take action, and that's why I was able to take advantage of the fears, because I was positioned that way. And now we're at a point where I'm slowly, and this is like gardening, you slowly trim and garden. It's basically start building up these defensive positions again so that I'm ready for the next time there's a panic again. And that could be a year from now, it could be 5 years from now, I don't know. I just like to be prepared so I can take advantage of them. So what I'm doing is looking at companies that are stabler or more defensive. So these would be sectors like consumer staples and stuff like that. Here's some examples of what I've currently been looking at. And these are all usually small positions that I kind of familiarize, and I'll build up as I go. And as the riskier assets, if they keep appreciating, I'll keep slowly trimming. But anyway, inaccurate brands is one on consumer defensive side, consumer staples, CN Rail. So rail companies generally always take price. They're very, in my mind, they're the least regulated industry for an industry that should be regulated more. Like, I just view their ability to take price as far superior to a utility company. So it's something I always look for when they're cheaper than average. And then you have Campbell's Soup for today's video. And then there's also companies that I'm also screening for 52-week lows that I think are overblown, like Salesforce, which is growing very well. It's cheap as probably been in a decade. So that's something that I'm looking at too, but that's not a defensive. That's just something that I'm trimming some things that are at 52-week highs and going into things that are near 52-week lows. And then there's also REITs, which are also more defensive in my mind. So we started videos, like we did videos on Dream and H&R REIT, which we own. I started positioning Reynolds, another defensive, Slate Grocery REIT, another defensive REIT. And then we've also restarted building positions in XLB and Zyros, right, and TLTW. So these are all positions that we're just starting, and basically what I'm doing is slowly trimming positions that have worked, right? We're up 50% on the year, and going into ones that are more defensive, basically. And that's the spirit of it. And it's not a like, oh my god, go defensive now. It's more just do slowly, gradually, just trim and garden, try to manage the risks best you can, and so that enables you to be able to take advantage of things when they sell off again, inevitably, which they at some point will. It's just the nature of the beast. So I just thought that part, if there's one part of the video that you really like, this part's probably the most important, because Campbell's, even as I went through it, I was like, okay, I'm not as confident in Campbell's as I thought I was, so I'm probably already thinking about trimming this and moving it to maybe to Target or Conagra or something like that. But that's just off the top of my head. So one of the reasons why we're looking at consumer defensives, not only are they defensives, but they're also been out of favor. General Mills, big brands, got killed. Kraft Heinz killed, right? Campbell's killed. Conagra killed, right? There's quite a few companies that have done very poorly and are trading relatively cheaper than their long-term averages, like over the last 10 years, right? There's General Mills, probably one of the cheapest it's been for a while, right? And look at these performances year to date. I'm at 50%, and Conagra's down 30%. Right, Campbell's is down 18, General Mills is down 20, right? These are material corrections for really big brands. They have a lot of big brands. So that's one of the reasons why we're doing the video, because I'm screening for them. And in terms of the PE, they screen relatively cheaper finally. Conagra's at 10 on the forward, Campbell's at 12, General Mills at 13. These are all cheaper than their long-term averages. So when everything gets cheaper in industry all at once, I'm likely to look at it. And then I have Target here, because that's probably a video I'm going to do at some point, because I just started looking at it on Friday. Anyway, Campbell's, most people are familiar with the product, so soup. That's what I thought when I always saw the ticker. I was like, oh yeah, that's soup, that's defensive. That's an exciting one to go into. That's why I started positioning it. And then I started digging. I was like, okay, there's a lot of things here I don't like that I've seen in other consumer staples that we've luckily avoided over the years, in my mind. Because most of the consumer staples have underperformed the broader market, right? You could have just put an index and probably outperformed any of the staples. Campbell's is a lot more than just soup now. They own a lot of brands. They have a whole snacks line. Actually, what I'll do, this visual is better. You can see Campbell's, Prego, V8, Chunky. So Campbell's, and they pretty much have, in my mind, a lock on soup, right? And soup's very cheap. So I would imagine they have the ability to take price here. Swanson, I think is fine. V8's good. Goldfish I do like, but the thing about meals and beverages, and these are the segments they report to, versus snacks, is that meals and beverages are, in my mind, the more defensive part of the business, and in my mind, the better part of the business. Whereas snacks have basically been these snacks, and honestly, I've maybe seen a few of these brands, and I don't know how good they are. Right? Are they going to be able to compete with the private label brands of Walmart or Target? And I don't know, especially as prices keep going up. So that's something to point out, is that the business model isn't just Campbell's soup. It's not all their sales are just soup. There's a whole lot of stuff going on, even though the ticker is called Campbell's. B stands for meals and beverages, and S stands for snack. A lot of their manufacturing in the U.S., which is good. It's just that a lot of their raw ingredients come from outside the U.S., which has hurt in this last bit. The sales, and this is probably contextually, this is why I think defensives or consumer staples are like this, is you look at 22 versus 23 and you're like, that's outstanding. You have 9% growth, right? 13% in snacks, 7% in beverages. Why does Freaky hate snacks? It's just, look at this price they were able to take in 23 versus 22. They took 15% prices up in snacks, right? And saw very little sensitivity, only 2% volume decline, right? Here they took 12 in meals, beverages, and saw 5. So they actually saw more sensitivity in meals and beverages, which is opposite of what I was thinking. And then in 24, you see a kind of a more subdued playbook. So you still had volume declines, but they didn't even take price. They didn't even try. And instead they made an acquisition, which could be a good acquisition, could be a bad acquisition. I've just seen a lot of bad acquisitions in consumer staples, right? I've seen Kraft Heinz. I've followed it for a long time. I still haven't bought it, right? Or if I've floated in and out of it. And there's a reason why, is that these companies like to acquire to try to grow, to keep having scale and having power, to try to compete on a level playing field with the big retailers, the end sellers. So the Walmarts and Targets of the world. And it's just a hard thing to do because the acquisition price is usually very high. So they always have big intangibles on their book, and then they always seem to write them down. And I hate that. I hate that so much. So anyway, that's worth pointing out, just how much price they're able to take over the years. And now all of a sudden they seem a little bit more gun shy because they're seeing more sensitivity, or at least that's what I'd argue. That basically tells you that they think there's competitors out there, and maybe if they try to raise prices, they're going to see more volume declines. And that's just me out loud thinking. Another thing I don't like when you see EBIT flat for the last 3 years, right? It went up in 23 because they took so much price, but it's come back down materially even though they didn't take any price. I'm like, okay, and then you had admin expenses up this much and you still couldn't take price? Like, you took more price in 23 versus 22, even though your admin shot up way more in 24 versus 23, right? So it's telling me, okay, they're being afraid to take price. Here you have the interest expense shooting up because they're making acquisitions to try to grow, so their debt's going up, right? So there's things I don't like, and there's things I do like. Here's a good waterfall. This is more current data for Q4 25. They just reported this. That's why we're doing Campbell's today. Volume and price, you can see volume down 4, price up 2. So they're trying to net it out. They're up here because of the 53rd week, which is fine. You can see the price takes on the margin side. So going up, good for margin. However, inflation on their cost was 4. So they only pushed price 1%, and they saw their costs increase by 4. Now, and this is to their credit, they are making a lot of productivity improvements. So is General Mills. So are all these consumer staples, because they understand that they can't just push the price that they're seeing, whether that's from tariffs or from raw input ingredients, right? So they're basically cutting costs in other places. So they were able to offset a lot of this inflation through cost cutting. So that's something they have done, but you can still see the pressure, right? 31.4 to 30.5. So 90 bips year over year. The tariff mitigation, we've talked about Section 232 steel when we did the steel dynamics video. And I think this tariff will actually stick, unlike a lot of the other tariffs over time, like over the long run. Mitigation levers, they are able to mitigate a lot, and I thought this was pretty good. When I saw this, I was like, okay, well, they're mitigating half of it, so maybe they'll be able to take share from other people that can't mitigate that much. But then when I go to the guidance for next year, and this is what really got me, I saw the guidance and I read it a few times, and the stock went up, right? Like, I think we're up 5% in the position, and I was like, I was surprised to see the stock up on such a bad next year guide. So either the market doesn't, or the market thinks this is too bad to be true. Like imagine being 12 to 18% less profitable year over year when you're a consumer staple, and your conception is that you're pretty defensive because of your soup lock. I think we got soup on lockdown. But this guidance really got to me, and I was like, oh, what should I do? So I started digging into other defensives and other businesses I might like more, right? So that's why I started looking at Target on Friday, because that's something I'm thinking about in my head right now. And even going through this video and listening to myself talk, I know I'm probably like, okay, do I really think Campbell's is going to outperform the general market? Is it going to give me that defense I want? So these are thoughts that I have to come to a conclusion to, but it's just sharing it with you guys. Here, they are doing a good job removing costs, but that's something you can only do for so long. Like I've seen Walgreens take a lot of costs, and they went from $60 to $30 to $20 to $10, right? And that was not all Walgreens felt. Those horrible policies. And then the healthcare pharmacy side just getting squeezed over and over again, and then getting hit over the head with the opioid crisis lawsuits. It's just, I've seen this playbook before, and so I'm kind of like, And then so I asked before they reported, I was like, what are the estimates for the next years in terms of EPS? And these are the annual expectations for the years. And I was like, okay. And the price at that time was only $30, so cheaper than it is now. And I was like, okay, so we're getting like 9 to 11 times. And then they give the guide though, and it's 240 to 255. So I was like, and your analyst average expectations was 280, right? So material decline in EPS, and then the thing went up, right? And the ISO was raising it wrong by like 30 to 40 cents. And so when the market went up, I was like, what's happening? Like I was expecting pain. So I'm thinking management is sandbagging, but I don't know that, or at least that's what the market's thinking, because it does seem like a very extreme drop in EPS, right? Like imagine telling everyone you're going to be 18% less profitable. So I just want to bring that up. What else can we say really quick here? Like I said, this should be a shorter video. The balance sheets for a lot of these consumer staples are never great. They're never horrible, but they're never amazing. I haven't seen too many that I'm like, oh yeah, right? Whereas the tech space is full of great balance sheets usually, because they don't have the same access to debt, right? They basically went through the whole venture capital side. They're basically all equity. They came out with big IPOs, so they had a lot of cash to sustain them, so that they don't have the same type of debt. Whereas these bigger, slower companies have had to take on debt over time, especially on the acquisition side. And that's what these intangibles are. And I view these just as ticking time bombs and all these balance sheets of brands they've overpaid for, and then they impair them over time. And that's what this is, going down 400 million year over year. They're just, we overpaid for this X amount of years ago, and we're slowly writing it down because the brands aren't as good as we thought. And I've seen this so many times in the space that it's just like, I don't even like to look at this space. You could probably tell I'm a little jaded, but like I do like the defensive properties. It's just hard to find a strong one where I'm like, okay, I'm not walking into another impairment or a material EPS decline like what they just guided to, right? And you can see the debt slowly build up as well, even though it's still at, I think it's 3.7. I was like, yeah, 3.6, 3.7 leverage. So not horrible, but not good, right? 3 to 4 is probably okay. I'd say anything over 5 is going to be bad for this space. I would argue that anyway. The cash flow statements, still relatively fine. So stable cash flow, put a decent amount back into the business. So of the 1.1 billion, put 400 in. Of the 1.1 billion, put 500 in. Right, so you're left with 6 left over to play with, and they basically give a lot of that in the form of dividends and buybacks, about 500 million, right? So in aggregate. So the dividend's still stable based on their current cash flow. We'll see how they perform next year when EPS is supposed to go down 12 to 18%. But that's another thing to keep in your mind. This one looks okay still, but that's something to think about as the underperformance of the business continues. If it does, then the dividend could come under pressure, but right now there's still a little bit of room. Right, and they also have room on the CapEx spend if they wanted to cut down like they just did year over year. There is another thing here on the snack side. This is a narrative just in snacks in general, that the demand is going down because of all the GLP-1 drugs. So that's the Wegovy's of the world, the Ozempics of the world, right? Just eating less. And they just don't know the impact. Both the businesses themselves, but also the analysts and how to model that. And so that leads to more uncertainty, which should lead to lower valuations until they're more certain, whether that's a good or bad thing. So that could be an opportunity if I were to say, I don't think it's going to have an impact on snacks, but I'm not sure as well. So that's also a thing for trepidation for me, right? And then tariffs as well are likely to impact the business. That's why they're guiding to what they're guiding. They're basically saying they're going to get hit with tariffs and they're only going to be able to push so much price out, right? And cut so much price out. So they're going to basically they're saying they're going to eat some of the cost of the tariffs, or the investors are. That's how my brain interprets that. There are some positives here, like the successful integration of Sovo's brands, which is the reason why the debt shot up, why the interest expense is higher, right? And why their brands and why their growth is better too, right? It's just not all organic growth. These things do grow by inorganically by acquisitions. There's a reason on the positive side that they're doing it. There is the cost savings there, right? The AI thinks that there could be a segment recovery in snacks just because it's been down for a while, which is true, right? That we have seen the whole sector go down. So that means that it's the whole sector, which usually means there's opportunity. So I do like that comment. I do like the resilient meals and beverage business. I think it's far superior to the snacks business anyway, just because of how sticky it is. Like if I want it offensive, I want it to be defensive, right? I want more Campbell's soup and less chips. So that's how my brain thinks, but that's just me. What else can I say before it's over? And then in terms of like how much cheaper is it to his long-term average, the current P ratio is 14. It's actually cheaper than that. Though if you would take the guidance, maybe not anymore, right? So the AI, I think it was just taking the current guidance and basically saying it's about 17.5% cheaper than the 10-year average and 10% cheaper than the 5-year average. So not dumb cheap yet. But again, this whole space is relatively cheap than its long-term average. So it's worth looking at. Anyway, I'd like to know your thoughts on Campbell. If you have any other defensives that are smaller or bigger, let me know. I'm probably going to start looking at Target soon, just because the valuation looks pretty interesting for what I view as a superior business to these consumer packaged goods. But yeah, I'd like to know your thoughts, and have a great rest of your weekend.